Think beyond traditional business banking. Think a partner that gives you in-depth financial insights.
Well, if you have just tuned in, you are watching the Power Table. And on the Power Table today, we are discussing where markets are likely to go in 2024. So you'll remember that Russia's invasion of the Ukraine, stubborn inflation, rampant interest rate increases, and also fears of recession were the main risks that investors faced at the start of 2023. So as we prepare to close the year with inflation having cooled in most parts of the world and rate hikes having subsided in most parts of the world, what headwinds could be on the cards for markets in 2024? And more importantly, where will the money be made? I am joined by Malungelo Zilimbola, the CEO at Mazi Asset Management, as well as Izak, Odendaal investment strategist at Old Mutual, to help us understand where we should be positioning our portfolio for 2024. To the both of you, thanks so much for your time. Malungelo, thanks. Let me begin with you, because if we take stock of what markets have done so far right now, as the picture does stand, December, we've got the JSE pretty much at the same place where it started the year. It looks like a lot of the money was made over in the US, in the tech sector specifically, although we do see the Dow Jones also having done a bit of heavy lifting in the year. Europe, it depends where you are looking in Europe, but the performance is mixed. I think that's the most accurate way to put it. But just in terms of what the picture does look like now as we prepare to wrap up 2023, your thoughts on where we are likely to land and how that will influence what 2024 could look like?
Absolutely. Thank you, Fifi, for having us on the program. Good afternoon to everyone. Yeah, so it's been a very difficult year. It's been a year which we call a stock pickers market, where the markets didn't do much, especially in South Africa. You're quite right. I mean, we dropped about 4.5%. That is the JSE in South Africa. If you're a good stock picker as an asset manager, you could have picked up some of the good stocks, especially some of the gold stocks that have done very well, especially in this environment where there was a lot of geopolitical risks. There was a lot of, really tensions, whether you're looking into Russia, Ukraine, or you're looking into the Middle East. So there's been a huge amount of, uncertainty and volatility. And therefore, if you're a good stock picker, I think this was the market for you. As you said, some of the stocks, in the US have done very well, especially on the tech side of things. And where we're going to land this year, I think that we're going to land at about where we are today in terms of the market in South Africa being about 4%. And if you look into next year, I've actually looked and found that, what we have in terms of the risks are still there. If you look at geopolitical risks, they're still there. In fact, there's a lot of elections coming up next year. South Africa is going to elections come May 2024. The US is going to election. Canada, Mexico. There's a whole string of countries that are going to an election. And normally that kind of pose a political risk, if you like. I mean, I don't have to overemphasize the political risk that we have in our country, given the potential, change of regime, as some of the polls have been showing us. So we're going into a very difficult year. So unfortunately, I can't say that it's going to be an easy year into 2024. As you've said, inflation is under control, but we're still going to live with higher interest rates for longer. And therefore, yes, there might be cut, by the Fed, let's say come mid next year. But we still, today Fed will be speaking. I hope that they'll keep the rates at 5.5%. But looking to next year, I think that's when we'll expect some cuts by the Fed, say middle of next year.
Okay. And Izak, your view, but to the point that Malungelo was making about it being a stock pickers market, I just want to zone in on the JSE specifically. If we do look at what the industrial complex, for instance, is doing, it's on course to finish the year slightly higher than it started. The financial index as well. We've heard a lot of commentators talking about stock picking in the banking and the financial complex because of some of the moves that have been made in that complex being overdone in their view. But we've also seen resources being on the losing board in terms of market performance so far for the year. So just your reflections on where we are likely to land and how it will shape up 2024.
Yeah, I mean, the year is obviously almost over. So I think, where we are today is pretty much where we are going to end up this year, barring some, either great move up the last few weeks of the year or some sort of catastrophe. No, it's been a tough year locally. And I think particularly the resources side of things has been really difficult. Now, Malungelo mentioned the gold price, which helped the gold miners, but of course the platinum miners have really, really struggled because of lower platinum price and particularly the lower palladium price. And so much so that there's now talk of job losses, shaft closures, etc. It's really a difficult environment for the miners. Of course, not just because the commodity prices, but they have to contend with load shedding, the inadequate logistics, rail sector, and so on. So it's been a difficult environment, particularly for miners in South Africa. I would say that the performance of the financials possibly a little bit surprising. If you stood at the start of the year and said we're going to have a good performance from financials in an environment where consumers are going to be under pressure and rates are going to be higher, I think that's maybe a bit surprising. And I think the industrials, of course. Big component there is just what happens in China and the impact on those kind of industrial stocks that really do business outside of South Africa. Now, if we look towards next year, again, I think you have to say, well, what's going to be different from this year? What is going to be different is that the interest rate cycle has peaked. Remember, when we started this year, there was still massive uncertainty around the global interest rate cycle and the local interest rate cycle. So at least into next year, we know that rates have peaked and the next move is going to be down. Now, you can debate how much rates are going to be cut in South Africa, in the US, the exact timing of it, but at least you are looking towards a period where rates are going to come down, and that should be good for markets overall, but it also depends on why exactly rates are being cut. So if you're cutting rates, and I'm just talking about the US now, if you're cutting rates because inflation's under control and the labor market is not as tight anymore and the Fed is generally happy with the way things are and they cut rates, I think that is very positive for a whole range of financial assets. If, however, the Fed is cutting rates because it suddenly gets a growth scare, it suddenly becomes concerned that the US is tipping into recession, I think that's obviously a very different environment. And that's an environment where you would expect your bonds to do very well globally, but obviously stocks, including South African stocks, could come under pressure.
Sure. I'm glad that you mentioned the various scenarios that could cause the US Fed to cut rates, because ultimately I think that is the big question mark that most people have, because going into the year we were told that 2023 would be the year where the US specifically would have entered recession just because of the quantum of interest rate increases that have been put through the system. I think north of 525 basis points or so since the Fed started hiking rates back in 2021. The recession didn't really happen. Some people say that it was a rolling recession if you look at specific sectors in the US economy, but at broad level, the last print for the US in terms of GDP, we're looking at 5.2% for the third quarter. So it's a question as to what gets the US Fed to cut rates, given the fact that the economy is still seemingly holding up right now, and given the fact that also the US consumer continues to be resilient, the labor market continues to be intact, it would seem. So, Malungelo, maybe you can help us understand what your thinking is around what motivates a rate cut potentially in the US in 2024, and ultimately in that eventuality, where the place to be is to make money.
Yeah, to start off with, what is a recession? A recession is when you get contraction in the sequential quarters. That's really the technical, name for a recession. Yes, you may find economies dropping into negative growth in one quarter and maybe positive on the other, but if they're not sequential, you may not call that a recession. Coming to the US has been incredibly strong, as an economy. And for many people that have called recession, you're quite right that they've been disappointed. Our view as Mazi is that we don't think that the US will go into a recession. We think that yes, the inflation is under control. The rate cuts will start because the inflation has peaked, and that the inflation is actually closer to the inflation target. That's the most important thing. The trajectory of the inflation from where we're standing is going to fall within the target of 2% in the US. And we think that that's a condition under which the US will be cutting rates, and not that the US will be going into a recession. We've not, in our research, concluded that there would be a recession in the US. We think that that economy is quite resilient. And if you look at job losses, for example, in the US, or rather unemployment is sitting at about 3%, and that economy is really, really well managed, if you like, and we don't see it going into a recession.
Sure. Izak, your view briefly here. I mean, have you also ruled out the prospects of a hard landing, as it were, and baked in, a soft landing being a done deal in the US?
No, nothing's ever a done deal. But no, I think the soft landing scenario has become more likely. At least for the next 12 months or so. So just because we don't get the recession now, it doesn't mean we're never going to get recession. You will get one eventually. But I think given the strength of the US consumer that Malungelo has spoken about, the ongoing strength of the labor market, it's very hard to see a recession. So some sectors are struggling. Clearly, if you look at the housing sector in the US, high interest rates are definitely hurting the housing sector. The manufacturing sector remains under pressure. And I think that's largely sort of still the aftershocks of COVID and kind of the big swings in supply chain problems and so on. But broadly speaking, I think consumer strength will keep the US economy chugging along. I think it will slow down, right? So you are going to see slower growth. That 5% growth we saw in the third quarter was definitely the peak. You're not going to get a repeat of that. It's going to slow down heading into next year. And if inflation continues to decline, I don't think it has to go all the way to 2%. I think the Fed will be comfortable with cutting rates as we approach 2%. Partly because remember that they really care about real rates. So real interest rates matter for the economy. And as inflation falls, of course, the real interest rate will rise. And I think they will make adjustments towards the end of next year for no other reason, just to make sure that the real interest rate doesn't rise too much and then put additional strain on an economy that's slowing down anyway. So yeah, definitely, I think the soft landing scenario has really increased in probability, and even just given the data we've seen over the last couple of weeks, and that's obviously also why the markets have been so excited starting in November and into December.
So, Izak, coming back to you, China, you did mention it. It was a talking point at the start of the year. It was supposed to be the first year China is out of full lockdown, and, we were supposed to be popping champagne and just toasting to the comeback that is of China. It hasn't been the case. For many, China has been the one of the biggest disappointments for 2023. Its economy certainly not punching as was initially expected. And just what does China look like in 2024, in your view, and what ultimately does that mean for stocks?
Is that for me? Sorry, go for it. Sorry, Izak.
I'll come to you, Malungelo.
No, look, I think let Malungelo talk about the stocks. I'll just quickly talk about the macro. I think it's a case of stabilizing. The Chinese authorities are going to put a lot of stimulus into the system to stabilize the growth, but there are some serious long-term headwinds facing China that are not going away. And I think these headwinds come to the fore: demographics, debts, property, and that's going to be a longer-term problem for China.
And
yeah, if I may add, Fifi, to that. So. Yes, China has been very disappointing in terms of its recovery, especially after the hard lockdowns. everybody expected that, post the hard lockdowns, China will stimulate its economy as it usually do, especially after a difficult period. And the numbers that have come out has been very, very disappointing. Whether you're talking about demand for iron ore or demand for PGMs and other commodities, it has been very disappointing. And what we've learned recently is that China is not going to go back to the old days where they go to build infrastructure in order to stimulate the economy. Because they've built the infrastructure is there. In fact, they've overbuilt. If you look at housing, there's still massive houses that are being completed today because they've overbuilt. So infrastructure development or investment is not going to happen, and therefore the demand for the likes of iron ore is not going to come through. So where China is going, China is wanting to position themselves in the industrial environment where they get involved in tech, for example. There's a lot of AI, artificial intelligence that China is embarking on, production of chips, and that's how China wants to position itself in the industrial environment going forward, and in innovation. Those are the growth areas for China, not the old infrastructure that we are used to. And therefore, when we talk about China, I think for me, you're talking about two things: industrialization, especially for these high-tech industries, and number two, they're trying to push consumption. Consumption has been the one that's been lacking quite a lot, where you can't get Chinese consumer to go and spend. Even after they've been saving a lot of money during hard lockdown, they've not gone out and in a splurge and spend. They've got this high, savings culture they've got. And I think one would expect that after this traumatic period of hard lockdowns, they would actually even be more conservative and save a bit more. So to expect the Chinese to come out and consume and drive consumption, I think it's not going to happen.
Sure.
We are dealing with a different animal now. It's not the old China that everybody used to know. And therefore, in the way that you engage China, you've got to really engage them more on the high tech, stuff, and very slowly but surely, the consumer will spend, but it's not going to happen in the medium term.
Of course, and that's what the numbers are showing us, that very slowly the consumer is delaying spending, because unlike in other parts of the world, China's got a real deflation problem. And we do know that, as consumers, if you're expecting prices to go down, you'll likely delay the purchases of big or small ticket items, which is what we have been seeing in the recent while. But Malungelo, from a stock perspective then, in this new China that you're talking about, what does that look like in terms of where the value could potentially be had? You mentioned tech and innovation and AI and the like. So does that mean one should, if you're putting new money into that economy, or you're looking to top up on existing positions, do you rather top up on the likes of a Naspers or Process, or Naspers and Process? Do you still bet on the fact that the well-to-do Chinese consumer still likes luxury, so you go the Richemont kind of route, as opposed to the mining stocks which we have seen being chucked out like hot coal sort of this year? Is that the play for 2024 in your view?
Yeah, so I would say, if you want to play, some stocks in China, the most well-positioned ones would be in the tech environment. And you're looking at something like a Tencent, for example, bearing in mind that, in 2 years ago, China had this common prosperity, which really hammered a lot of these tech stocks. But it looks like that message has been moderated. You've seen these stocks rebound in terms of performance, whether it's revenue, profits, but the ratings are still lagging behind. In other words, the PEs that you're buying these stocks at. So I would say that your good bet would still be in those stocks, your Alibabas of this world and your Tencent. And also then, if you go to the commodity side of things, you have to look at commodities where the so-called just transition commodities. not your usual dirty energy like your coal or iron ore that goes into infrastructure. But you've got to look at some of these, just transition commodities like copper, for example, nickel. Those are the commodities that China is going to demand, and China has been quite advanced as far as production of EV, which is your electrical vehicles, and I think they are quite ahead of all countries, including the US, as far as the penetration of EV is concerned. And some of those commodities like your copper and your aluminium. So those would be the stocks that really go into that environment, and not necessarily your bulk commodities or your dirty energies in terms of going into China.
Okay. Izak, so Malungelo mentioned the geopolitical risk still being very much a threat for market positioning, and also made mention of the elections. I mean, there's so many elections happening next year. It will be quite difficult or interesting to navigate. I mean, from large economies like the US to large economies in Africa like South Africa. And I'd like your thoughts on the South African picture specifically, and what that potentially could mean for market direction. I'm hearing conflicting views around the possibility of coalition government at national level, and whether that will be a great thing for policy certainty, growth and investment, or whether it could also inject further uncertainty into investing in SA Inc. Just your thoughts on the election risk in South Africa specifically, and whether coalition government is good for markets or not.
Yeah, I mean, let's just be clear. There are only two elections that matter. I mean, there are a lot going to be taking place next year, but only South African election will matter for South African investors, as will the US election. The rest are kind of sideshows. So in terms of South Africa's election, I mean, it's a tough call. I think we should prepare ourselves for the possibility of a coalition. But I think, looking at the polling numbers that we have, it does look like the ANC will get close to 50, maybe slightly below 50, in which case they can form a coalition with, one or two small parties, which to my mind suggests it's kind of business as usual. It's a continuity of the policies that are already in place. And some of those policies are, of course, positive. If you're thinking about liberalizing the energy sector, liberalizing the logistics sector, the kind of general trend towards building more infrastructure, general trend towards more private sector participation in key network industries, all those things are positive. And I think, that kind of outcome the market will be okay with. Obviously, kind of if the ANC support drops substantially, let's say down to 40%, then it's a different ballgame, because then you need to find a big coalition partner. And then there really are only two options. You either partner with the DA, which I think would be a market-friendly coalition, likely or unlikely as it may be, or the ANC partners with the EFF, which will be seen as a market-unfriendly coalition. But I think my base case view is that it's going to be more of the same, which is, it's good news from a policy point of view, but it also means we're probably not going to see kind of really sped up implementation. We're still going to have the same kind of pretty drawn out implementation timelines on some of these important policies.
Okay. So, Malungelo, if we take this conversation home then, but if you care to share briefly, 3 stocks we should be putting in our under the Christmas tree, or the Christmas sock. You can see some of us who didn't grow up in houses where there was Christmas decoration and all that. But 3 stocks that will, have us cheering, beyond Christmas, that potentially could continue to add value in 2024 from SA Inc. What would they be, sir?
Yeah, so that would be an MTN, for example. MTN we quite like. It's quite cheap. It's been really unfairly punished recently because of the issues of Nigerian currency, where the currency there was devalued. And as you know, Nigeria is the biggest asset in MTN. We think that the fundamentals in Nigeria are very good. These guys are the largest player, mobile player in Nigeria. And they also have this big opportunity of mobile money. Mobile money is quite good and is profitable and is growing for MTN, especially for the unbanked markets like Nigeria. So we think that the potential is big, and also they've crystallized the value when they sold their fintech asset or partnered with MasterCard on the fintech asset, and that unlocked about 100 billion rand. So that's the stock that is cheap, it's well managed, it's got growth potential, both a turnaround from here at home, and also just continued growth in those African markets like Nigeria. So that's the stock that we quite like. And also, if you're coming from the banking side in South Africa, we've picked Absa. Absa is one of those banks that have also underperformed quite a bit, especially after the demerger with Barclays. They're starting to rebuild, especially the Absa Capital side of things, which is actually going very well. They've resolved the leadership issues. That there was departures of the CEO and also departure of the chairman. So it looks like they've stabilized management where you've got a good chairman in place and a great CEO. And the leadership issues seem to be behind us in terms of that company. And we think that with interest rates coming down next year, and which will deal with some of the credit losses to somehow normalize, we think that stock will do very well for us. And then I think obviously there's some big turnarounds in the markets. And that we are looking at,
right,
between Capitec, Transaction Capital, which has really been beaten very hard. It's a risky call there, and especially the taxi business, which have suffered, given high petrol prices, where commuters are not able to take these tariff hikes by taxis.
Sure.
And also had that We Buy Cars that also suffered because of the weak consumer. So we've done the numbers, done some of the parts for the stock. We think that although there is risks out there, the stock is actually giving you a big potential. It's recovered nicely. It's trading at about 8 rand or so. We think that there's more upsides, to about 16 rand.
Okay.
Those are the three stocks that I'd put up: MTN, Absa, and Transaction Capital, which is a bit of a risky call.
Okay. No decision is exempt of risks, I'm sure, but as you said, you have done your calculations and the sum of the parts outweigh the returns. But Malungelo, thanks so much for giving us those picks, as well as sharing the broader market insights for 2024 potentially, as well as Izak. Thanks so much for your views, sir. That does bring us to the end of the Power Table with Malungelo Zilimbola, CEO at Mazi Asset Management, Izak Odendaal, investment strategist at Old Mutual.
This program is in partnership with Nedbank Commercial Banking, a banking partner that thinks bigger to guide your business growth.